Assalamualaikum and hi everyone. My name is Siti Fatimah Amalina binti Abdul Razak and I am from A4CS1124A. Today we are going to move on to the next chapter, which is Chapter 3, Meeting Consumer Needs. Today we will be discussing tutorial for week 7. So the first question is, changes to family composition prove to be major contributors to financial instability. Young adults living home frequently see a dramatic drop in their standard of living. Interest is also the spread and volatility of income progression in the light of changes to inflation and other economic variables. Briefly explain further details about the risks as discussed above. We will talk about the expense risk. So what is expense risk? Expense risk is to measure the sensitivity of the insurance company liability for the resultant in higher expense rate than charged in the premium. There are 5 expense risks, which is the divorce, property, medical costs, interest, and inflation. The first one is divorce. Divorce is the major source of financial hardship and is probably uninsurable. The law may compel the bearer-of partner, probably the non-custodial parent if there are children, to contribute to the support of the poorer partner, overwhelmingly the mother. The financial ramification involved could include a new rental or mortgage payment for a separated spouse, as well as new alimony or child support payments to be made for both the short and long term. Next is the property. People normally accumulate tangible assets as they age. The most serious loss would be significant damage to a house. Losses to car, household appliances, and furniture are likely to be less significant but might still be worth insuring. Insuring against the damage that one's own car might do to other people's property and person is likely to be compulsory in the form of public liability insurance. Next is the medical costs. The medical costs can be divided to different categories for the purpose of examining their impact on people's financial security. The smaller costs, such as visits to the family doctor, which are unimportant financially to most people, the cosmetic operation, and time in luxury hospitals, can be paid if the people have the money. In the middle are expenses that are necessary but cannot be paid out of normal income. They can, however, be covered by medical insurance. Medical insurance pools the risk, so turning irregular and potentially crippling costs into easier regular payments. The fourth one is the interest. Changes to interest rate become a problem when relatively high and volatile inflation leads to dramatic increases in mortgage repayments. Variable or floating rate mortgage loans allow lenders to change interest rates after a short period of notice. If a mortgage loan has a long outstanding term, a significant proportion of the remaining repayments will be interest. A 50% increase in the interest rate will translate into a substantial increase in mortgage repayment, as lenders may allow installment of up to 30 months of a person's before tax income. Such increases can lead to a severe hardship. And lastly, the inflation. People may retire for 30 years or more, over which period is clearly necessary to allow many unexpected changes in the general level of prices. These are the most at-risk inflation are those on a fixed income, such as the pensioners. The second question is, the financial risks encountered by individuals in the course of the life cycle can be categorized into 3 categories, which are risk to income, risk from expenses, and risk in savings. There are 3 obvious life contingencies that reduce family income. So the question asked is to explain this income risk. The first one is definitely the death. If some family members are fully or partly dependent on income earned by other family members, the lives of the income earners should be insured. The second one is disability. Where disability leads to a loss of income, there is a need for income replacement, whether the disability is temporary or permanent, total or partial. This can be provided by insurance. Disabled persons need rehabilitation. Rehabilitation may require special equipment and other provision and needs special effort from family, employer, and insurance provider. The last one is unemployment. The most important cause of income reduction recorded in Duncan's 1988 study is reduced employment, normally in overtime, which often makes up a significant proportion of the wages or total unemployment. There are indications that unemployment may become more of a problem in future than it has been in past. The greater efficiency of manufacturing industry worldwide, rapid technological change, and policies encouraging free trade create pressures on companies to be globally competitive. This often means laying off staff in order to cut costs. That's all from me. Thank you.